Well, we've got a couple of managements lined up on the show, so let's get straight to our first management. Mr. Ashish Rai, the Vice Chairman and Director of Aurionpro Solutions, joins in to discuss about what was a rather muted set of numbers actually on the margin front, though revenue growth continues. Hi, sir. Morning. Thanks so much for joining in, Ashish. Give us a couple of details. Now you're talking about a 30 to 35% revenue growth. So you'll end this year with a revenue of close to around 900 crores. My question to you is, are you being conservative? Point number one. And also, do you stick to the earlier guidance on the EBITDA margins front, which you were talking about roughly around 22%, and net profit margins of around 15 to around 16%?
Hi, Nigel. Good morning. First of all, thanks for having me. So 30 to 35%, as you have seen last year, we were accelerating through the year. The second half was a lot stronger than the first half. Q4, we were up to almost 39% revenue growth, right? So we see very, very strong demand momentum for our core offerings. So we feel very good about accelerating. I don't think it is conservative. I think it's a fair range for us. We expanded 31% last year on revenue. PAT, of course, went up 35%. It's sort of a fair range, and we are accelerating through the year. If at all we see more demand ahead and the rates are higher, we'll come back and update that. But for now, that's the range.
So Ashish, around 900 crores is what you'll do. And if I calculate around 15% roughly, net profit margins, you'll do roughly around 130 crores of PAT. You're already doing 100 crores. So, I mean, yeah.
Yeah. So that's roughly the range. So we basically 850 to 900 is the range that we will be in. And we are operating at EBITDA, let's say 21, 22, and PAT at 15 to 16, right? So I think that's where we'll add up.
All right. And what explains the margin decline in the fourth quarter, quarter on quarter? Just wanted to understand that, because you've been guiding for this 22, 23% sort of band. In the fourth quarter, it fell to as low as 21.2%. That's one. And secondly, what's the order book that you're sitting on that gives you the visibility of 30, 35% growth?
Yes. So on the margins, actually the EBITDA margins are fairly strong, right? So what you saw was a one-off tax effect that we had. We were planning a tax incentive against an R&D with our subsidiary in Singapore, which did not come through, and we decided, and so that sort of came in on Q4, and that's essentially sort of explains the muted PAT. I don't really agree on Q4, right? But I don't. The earlier statement we made around margins being muted, I think we are still probably one of the most profitable shops in Indian tech. EBITDA margins, we are still driving 21, 22%, and that will stay. That was a one-off Q4 impact of tax.
And what's your order book?
So order book now is about 820 crores as of, that is what we closed Q4 with, which is strong enough for us to have a very good visibility on the growth that we are going in. So, so are the 820 crores, at least 700 crores is kind of deliverable over the next 12 months, depending on our capacity. And the rest of it we will make from the sell and deliver we do within the year.
All right. Give us a couple of more details, Ashish. How much of your business is coming in from the government? Because I understand that out there, maybe receivable days will be a little bit higher. So two-part question here. How much of business is coming from the government? And what's the receivable days currently, and what should we be working with?
Okay, so look, it's important to understand the structure of our business, right? So about half of it is banking, slightly more than half of it is banking, which is not government at all. The other half is 48% or so is technology innovation group. The government business is a part of it. So you're talking a business which is about, let's say, 15 to 20%. We also work with a lot of transit organizations which are owned by government, but I think the receivable cycles there are very different because these are kind of revenue share deals and all, right? So it's a pretty small, it's like 15 to 20% of the business. Receivables do go up. So we ended the year with DSO at about 110 days, which September it was 115. So it came down a bit. I think we will probably keep our receivables at about 100 odd days as we progress the year.
All right, 100 odd days on the receivables. Just a couple of other questions. The cash on your books, what does it stand at right now, and what's the plan with that? Because you are, ramping up hiring. You've added what, almost 400 staff members over the last couple of quarters. What's the hiring plan, utilization of cash going forward?
Yeah, so we're hiring at a clip of about 300 incremental hires in a quarter now, right? 250 to 300 incremental hires. We had about 500 in the last thing. So what is happening, Mangalam, the way to look at your question is, we are building out a global IP-led products and platforms player, right? For our core products, the build is done. We are pretty much tier one in terms of the quality of the IP. We are leaders in most of the Asian markets we are in. We are looking at global expansion. So the demand is really very, very large. So it's doing two things to us. One, we will ramp up the capacity to invest in R&D as we go into newer markets. We are upping the R&D spend to make the products better for the local markets. Second is, we are starting more projects than we are finishing. So there's a constant demand even on implementation and all. We are not as resource intensive as a typical, let's say, IT services business, but still, the capacity will keep going up quarter on quarter.
All right, final question before we let you go then. Promoter holding is at around 33%. Just going by the numbers, the stock is trading at less than 10 times its forward earnings. Is there any intent that the promoter entity wants to increase the stake from this 33% on? And in the last 1 month or so, there looks like there's plenty of interest in the stock. Have you all seen some fund-based participation coming in?
So on the promoter holding, the insider holding, between promoters and directors is at about 50-odd%, which is, I think, the right level of holding we wanted to be at, because there's original founders, plus there are, other directors who joined along the way, including myself. So the goal is this, right? So a valuation question, I would kind of skirt that and say this. Our goal is to be in the top 5-10% of the industry, both in terms of growth as well as margins. We've done that for the last 2 years. We'll keep on doing it. That's what the plan is. The management team has 3 levers to drive that value of the enterprise. One is growth. We're doing very well on it, growing at 3 times the industry, probably more. Margins, we are one of the most profitable shops around, right? And the third thing is the IP assets that we're building up, which no accounting report captures, but we're building up incredible tier one IP, right? So we believe the value of the enterprise will keep going up. We'll let the market decide what the valuation is. As Mr. Buffett says, right? I mean, over the short term, it's a voting machine. Over the long term, it's a weighing machine. We're playing for the long term, right? So this is a 10-15-year play to create a incredible global IP powerhouse.
All right, we will keep that in mind. You have quoted Warren Buffett. Let's see whether your investors go ahead and get the returns from your company as Warren Buffett would generate from his as well. Thank you for joining in. With that.